When you go get financing for a rental property, the lender is going to do one of two things. They're either going to underwrite you or they're going to underwrite your rental property. If it's conventional, they're digging into every little facet of your life. They want your W-2 income, your credit score, and all your debts. If it's DSCR, it's just a couple things. And the main thing is they want to know, will the rental property rents cover the mortgage? That one difference completely changes how you qualify. So in this video, I am breaking down the difference between DSCR loans and conventional loans in plain old English. I'll explain how each one works, the pros and cons, and most importantly, how to figure out which loan option fits you as the investor. By the end of this video, you're going to have a simple framework to know which path to take before you even talk to a lender. Hi, my name is Franchini, and welcome back to my channel here at Brick by Brick Wealth, where I teach aspiring real estate investors how to be successful with their very first rental property. So here's the first problem that investors run into. They think getting a loan is a one-size-fits-all. Find a house, you go to the bank, you ask for a loan, and boom, you're approved. That's what people expect. But the reality is, there are different ways in which a bank can qualify you for a loan, and each method comes with trade-offs. Now, the confusion starts here. You start hearing terms like DSCR loan or conventional loan in Facebook groups or on podcasts or YouTube channels. And usually the way it's explained, it makes it seem like one of them is automatically better than the other one. Someone will say, oh, DSCR loans, they're the secret hack to scale fast. Someone else will say, conventional loans are better because they have lower rates. And if you're new, you're left thinking, well, which one's right for me? What am I missing? Why does everyone make this sound like rocket science? The truth here is that neither one of these loan options are universally better than the other. They're different tools, and that's the way you need to think of it. One is designed to look at you, the borrower, conventional loan, and the other is designed to look at the property, DSCR loan. That's it. The mistake beginners make is thinking that there's one clear winner, one better option, without really understanding the different facets of each loan and which one is right for them for this specific property. And that misunderstanding costs people a lot of deals. They either apply for the wrong loan, they get denied and never buy anything at all, or they end up with some financing that eats all their cash flow because they thought that that's the way they're supposed to go. And that's why this video matters today, because picking the right loan for your situation for this property is just as important as picking the right property. So we are going to strip this down to the basics. I'm going to show you exactly how a conventional loan works, exactly how a DSCR loan works, and then I'm going to put them side by side so you can see the differences for yourself. All right, we're going to start with the loan that most people are the most familiar with, and that is the conventional loan. Conventional loans hold the traditional path. With a conventional loan, the bank is underwriting you. They're analyzing you, the borrower. They want to know if you, personally, can pay the mortgage on the property. They don't care if it's going to rent out and make you money. They need to assume it's not going to make money, and they want to know that you can afford the payment along with everything else that you pay for in your life. So that means they're looking at your W-2 income, all your debts, your debt-to-income ratio, your credit score, and your overall financial profile. So if you've got a steady paycheck, a strong credit history, and not a ton of debt, conventional loan is going to be easy for you to qualify. And lenders love conventional loans because you've got a proven track record that you can pay your bills. So let's talk about the pros to conventional loans. The first one is lower interest rates. Conventional loans almost always come with the lowest interest rates. This translates to a lower monthly payment, which can make your cash flow better over time. And along the same lines as the interest rates, usually, conventional loans have less points. That is the upfront cost to actually get the loan. Usually, it's a percentage of the loan amount you pay the lender upfront to obtain the loan. DSCR loans are known for having these extra upfront costs. The second pro is the structure. Conventional loans are backed by Fannie Mae and Freddie Mac, which means that the guidelines are predictable. Everyone knows the rules, and you can usually tell if you're going to qualify or not based on just a few pieces of your financial information. But there are catches, so here they are. First, you'll need 20 to 25% down for a down payment on the investment property. That's a big chunk of cash, and it can be a big barrier to entry if it's your first deal. Second, lenders are really strict on the DTI, or debt to income ratio. Already got a car loan, student loan debt, credit card debt you're paying every month, or a big personal mortgage, it can eat into your qualifying ability. even if the property could pay for itself with the rent received. Third, there's a cap on how many conventional loans from the government you can have. Right now, Freddie and Fannie say you can only have 10 conventional loans under your name per qualifying income. And now that's not a problem if it's your first few deals. But if you're planning on building a larger portfolio, you're either going to have to pay some of those loans off to get new loan spots or use a different loan type. So the bottom line here with conventional loans is that they are really awesome if you can check all the boxes. But if your personal finances don't line up and it's hard to get qualified, conventional loans might not be for you. And if it is an investment property, DSCR might be the way you want to go. DSCR stands for Debt Service Coverage Ratio. It sounds complicated. It's not. Here's what it means. Instead of the bank looking at all your income and all of your debts and seeing how much you can afford to pay extra for this rental property, the bank just looks at the property itself. The property is qualifying itself. Yes, you have to have good credit. And yes, you need to have cash down payment and reserves so you can buy the property, but they don't even care if you have a job. Here's what this debt service coverage ratio loan looks like. It is a ratio. What the lender does is they take the projected income and they divide it by the mortgage payment, including the principal, interest, taxes, and insurance. If that number meets the required ratio, you're in. You're approved. Usually, DSCR loans are between 1.0 and 1.2%. For example, if a property rents for $2,000 a month, but the mortgage, principal, interest, taxes, insurance, any HOA required fees adds up to $1,600 a month, the ratio is 1.25%. And that works. Property's approved. But if the rent only covers $1,400 and the ratio is below 1.0, most DSCR lenders won't approve that. Now, I have heard of some DSCR lenders going as low as a 0.8% ratio, which if you're in my coaching program, you know that we don't want those properties because we need properties at cash flow. So any student of mine will have absolutely no problem qualifying their property for a DSCR loan program. We are not looking for a 1.0% property, which is a break-even property. We are looking for cash flow. So we are going to see a much higher than 1.0% ratio. Here are the advantages of going DSCR. First of all, they don't require you to give them your W-2 income, all your pay stubs and your financial history, blood of your firstborn. All they want to see is your credit score, obviously the property information, and that you have cash and cash reserves. They don't even care if the cash comes from you. You could get it from your mom the day before and then say, here's my proof of funds. There's also no cap on how many DSCR loans you can have. Like we mentioned with conventional, you have a cap of 10 per qualifying income, so 10 per person. DSCR, there's no cap. You could have a zillion. So scaling a portfolio is much easier with DSCR loans. Don't think that you're not going to be able to scale because you're not going to qualify for that many properties. You don't need to qualify for the properties as long as they are cash flowing and making money. Now, although those pros sound great, there are some drawbacks for DSCR loans, so we don't want to forget those. First, the interest rates and fees can be higher than conventional loans. Depending upon the time of year and what lender and what program and what's happening in the economy, and especially more in the recent past couple years, I have seen DSCR loan rates be lower than the competing conventional rates. So it's not always that DSCR loan rates are higher. They usually and often are, but there are plenty of times when they are not. So if the interest rate is your only factor, don't assume DSCR loan rates are higher. They may not be, and be sure to check with both types of lenders. The other drawback is that you still need a down payment, right? No one's giving you a loan for free with no money down, unless you're an owner-occupied buyer and you're wanting to live in a property and you're going, USDA loan or VA loan or something like that. But this is an investing channel and we're doing investment loans, right? Not owner-occupied. So we are not talking about zero down owner-occupant loans. So with DSCR, you're still going to need a sizable down payment. 5% is the norm. I have seen some lenders offer 15% down payment options. Another drawback is if the property doesn't meet the required ratio, right, on paper, if it doesn't cash flow, you're not going to get the loan, even if you could personally qualify for the property. So this brings into question Airbnbs and short-term rentals. Short-term rentals usually are at a higher price point. Usually they're in an AB neighborhood. If you want to see a video on that, I'll see if I can remember to link that down below to how to tell the difference between an A, B, C, D neighborhood. So if you want to invest in short-term rentals, it's not usually going to be in a regular, plain old, boring residential suburb. It's going to be in a place people want to go visit, and those prices are higher. Those properties do not usually cash flow as a long-term rental. So if you want to go short-term rental, you're likely going to have to qualify on your own using your own income the conventional way. DSCR loans are only for long-term rentals, or they're at least going to qualify your property as if it were a long-term rental. Even if you're going to rent it out, short-term rental, because it's on the lake and you're trying to use a DSCR loan, they're usually, I haven't heard of any that are going to use the short-term rental income. You'll have to go to a specific lender, usually more local lenders, that can offer a short-term rental financing, which is something we're not talking about today. So just keeping that in mind. The other con with DSCR loans are the extra points that the lenders charge to get the loan. So remember I mentioned in the very beginning that conventional loans usually have very minimal upfront points to get into the loan. DSCR lenders usually charge anywhere from 1 to 4 points. I've even seen 5 points, which I think is crazy. 1 to 5% of the loan amount you pay upfront in the very beginning. With your closing costs, you pay that directly to the lender as part of a lender fee to get the loan. So I'm not a fan of extra upfront points that goes in the lender's pocket. And the other drawback, and this is a big one to remember, is there is likely going to be a prepayment penalty. Usually it's either a 3 or a 5-year prepayment penalty. What does that mean? Well, it means that if you plan on refinancing the property during those 3 or 5 years, you're going to have to pay the bank a penalty fee for refinancing out of that loan into someone else's loan. Let's assume the loan has a 3-year prepayment penalty and the property loan is $100,000. That means if you refinance in year 1 of owning the property, you owe a 3% penalty fee, which would be 3% of $1,000. If you refinance the property in year 2, you owe a 2% penalty. If you refinance the property in year 3, you owe a 1% penalty. And then in year 4, you are free to refinance the property with another bank or whatever with no penalty. Personally, if I'm going DSCR, I want the lower penalty. Some DSCR lenders don't have a prepayment penalty, which is awesome. And some say that you can buy down their prepayment penalty from a 5-year to a 3-year or a 3-year to a 1-year, etc. So every DSCR lender is different. They all have different rules, and you can ask them for a DSCR rate sheet, and it can give you all the details for their loan program. So DSCR loans can unlock a lot of options, and they are much easier to get than conventional financing. All right, let's do a head-to-head breakdown so it's easy for you to see. Let's put conventional and DSCR loans side by side. When it comes to qualifications, with a conventional loan, the approval is based on you, your W-2, your income, your debt-to-income ratio, your credit score, and your cash reserves. With a DSCR loan, you're qualified based on the property's potential to make money, your credit score, and your cash reserves. When it comes to rates and fees, conventional loans usually and historically offer the lowest rates and fees to purchase the loan. With DSCR loans, they typically cost more with fees and interest rates. When it comes to flexibility, conventional loans are limited. Because they are backed by the government, lenders have to follow their sets of rules, and they aren't able to do you any favors. DSCR loans don't have as many restrictions. Since each DSCR lender is in charge of its own loan program, they can be more flexible to you. So, which loan should you choose? Well, conventional loans are likely going to be your best option if you have a steady W-2 income, have some cash saved, and have low consumer debt. DSCR loans will be your best option to use if you don't have personal income to qualify. If you want to dive deeper in how to make rental properties work with today's high interest rates, you're definitely going to want to check out this video, 8 Ways to Cash Flow with High Interest Rates. So the main takeaway is that either loan option works well. It just depends on what you are needing. They're just different tools. Not one is better than the other. If you learned something today about conventional loans or DSCR loans, can you please tell me what it is that you learned down in the comments below? I am doing this for you and I would love to hear from you. And please don't forget to subscribe to my channel if you haven't already. Ring the bell so you are notified of my weekly videos that I put out on how to be a successful real estate investor. And until next time, keep it building your wealth brick by brick.